In this presentation, we're going to begin the process of what is often called fundamental analysis. Now, we're only going to do a little bit, folks. Wait till we get to chapter 4. But we're going to start taking a look at some of the numeric measures that we use when looking at individual companies. But before we do that, let's take a look at some characteristics, some common stock characteristics. And the first one on slide 60 is a spin-off, a stock spin-off. This is a conversion of one of a firm's subsidies to a standalone company by distribution of stock in that new company to existing shareholders. In other words, a company is breaking itself up and selling off a piece of itself. Sometimes the new company is still majority owned by the company that spun it off. One of the examples of this was Kraft several years ago that was spun off from Altria, which used to be called Philip Morris. They also owned Miller Beer. They spun that off and they still own some stock in that. Then Altria sold off their international tobacco business, which is now called Philip Morris International. So figure that one out. Here's a company that was based in the United States that sold off a company that still is based in the United States, but that company only sells their cigarettes outside the United States. So it's a company that's based in the United States that does all their business outside the United States. Kind of bizarre, huh? That's the way it goes. The history of spin-offs has been checkered. Some spin-offs have done better than the companies that spun them off. An example of this was the Baby Bells. In 1984, the AT&T monopoly was broken up, and there were 9 regional Baby Bells, as they were called, the regional telephone companies. AT&T was left with their equipment manufacturing, which was eventually spun off as Lucent Technologies, and the long distance company. Well, the long distance eventually just fell apart because of new technologies. But the regional bells all started to do pretty well, and they started to eat each other until finally they were left with 2. Bell Atlantic, which is now Verizon, and SBC Communications, which eventually turned around and bought the old AT&T just so they could have the name AT&T. Kind of bizarre, huh? But sometimes spin-offs don't fare so well. Coca-Cola Enterprises, which was spun off from Coca-Cola, and Lucent Technologies, which was spun off from the old AT&T, are examples of disappointments. Coca-Cola Enterprises was the idea behind this was, hey, this is the bottling part of the company. Coca-Cola makes the syrup, makes the fizzy sugar water with the brown crayon dipped in it. Coca-Cola Enterprises put it in the bottles. And the idea was to give them the ability to work with anybody. It didn't work out so well. Anyway, so sometimes spin-offs do well. A big spin-off that has happened in 2023 is Johnson & Johnson. They've spun off a piece of themselves, and I really haven't followed it as much as I should. I can't even remember the name. It's like Kenvue or some strange name, but I really should, because that's one of my my favorite companies. You notice I don't tell you what companies to invest in. We're going to try to get over the next several weeks. We're going to try to get you to decide which companies you like. But Johnson & Johnson's been around for 140 years or something. Yeah, right. Now, a stock split on slide 61 is a very different animal. This is a maneuver in which a company increases the number of shares outstanding by exchanging a specified number of shares of stock for each outstanding share. So the most common is a 2-for-1 split, although there are 3-for-2 and 5-for-1 and the reverse splits. They're 1-for-10. What is that all about? But let's say it's a 2-for-1 split and you had 100 shares. Well, you now have 200 shares. Yippee! No. The price went down in half. It's an accounting maneuver. And there used to be reasons for why we would do this so that the price wouldn't get too high and it was easy to trade 100 shares. Remember, we were trying to trade in round lots. But now there's no reason to do this. There's absolutely no reason to do it. So now when companies do it, in my humble opinion, it's a way of saying, hey, we're kind of excited about what's going on in the future. So let's read together at the bottom, which will basically reiterate what I just said. There is no increased value from stock splits. If you had one share at $20, you now have two shares at $10. The value doesn't change. It's a psychological increase at best. For decades now, Warren Buffett of Berkshire Hathaway has refused to split his original stock since its inception. A single share now goes for around $550,000. Okay, yeah, right. And so this is what would one share of Coca-Cola would be, or one share of McDonald's, if they had never split the stocks. Right, that's how it works. Now, what's this reverse split? 1 for 10. Well, what's going to happen is you're going to have 10 shares, and they're going to take them away and give you one share, and they're going to make the price go up by a factor of 10. Now, why would they do this? They do this when they're desperate, because once the price gets too low, the exchanges, New York Stock Exchange and NASDAQ, say, we don't want you with $1 or 50 cents or whatever. So they will do a reverse split to push the price up to $5 or $10. And of course, there's no change in value. And usually when that happens, it's because the company has fallen on hard times. It's a bad sign. So we're going to ask you about stock splits. What happens when a stock splits? 2-for-1 split is the most typical. You double the number of shares you have, but the price goes down in half. It's an accounting trick. Treasury stock. What is this? Well, this is an interesting characteristic about stocks. These are shares of stocks that have been sold and subsequently repurchased by the issuing firm. It's called a share buyback or a buyback or a share repurchase. What happens in this case? Once those shares are bought back by the company, those shares are put in the treasury and are no longer in circulation. Share buybacks reduce the number of outstanding shares, and here's the logic. After the buyback, there is less supply of outstanding stock. Existing shareholders now have a larger percentage ownership of the corporation. So you see what's going on here? You economics fans, supply and demand. If you reduce the supply and the demand doesn't change, of course, everything's changing all the time, but if you reduce the supply and the demand doesn't change, what should happen to the price? It should rise. During the run-up of the 1990s, share buybacks were often seen as a better alternative to dividend increases. The belief was that investors were more interested in capital gains than dividends, and that buybacks increased the potential for capital gains by reducing the supply of stock. The Republicans pushed through a huge tax cut for corporations in 2017, and the idea was that they were going to pay people more money and invest more in their companies. What did most of them do? They turned around and bought back their shares, which helped the people who own shares, but it didn't really do much for the economy, but that's how it worked. So that's how share buybacks, share repurchases work. Slide 63. Classes of common stocks. Now, we see this not as much, but it's still around. At one point, General Motors had seven classes of stocks. These are different classes of stocks that offer different privileges and benefits to their holders. So there might be, the most you see now is Class A and Class B. That's mostly what you see. So for example, this is typical. The family, once the stock has gone public, well, they're not really too involved. Maybe some of them are. But the heirs are given Class B shares. Everybody else gets the Class A shares. Well, the Class B shares may not have voting rights, or they may have a whole lot of voting rights, but they usually will be paid better dividends. Right, There are various reasons. The Class A shares, though, are the more important shares. In the case of Nike, the Class B shares seem to be the more important ones. In the case of Meta, they set it up so that the Class B shares are controlled by the family, and they have far more voting rights than the Class A shares. Now, some shareholder advocacy groups are really upset about these methods of not allowing the shareholders to have one vote. You know, every share they had one vote, they have one say. But it basically nullifies that. So there's a bit of a controversy over it. Here's a great example, though. If you want to delve into the history of Berkshire Hathaway, recall that the A shares, the original shares, are selling for $550,000. Well, this was back in the 90s. And I forget, they were selling for like $30,000 or $40,000 a share. In 1996, the financial world pressed Warren Buffett to offer a lower cost version of his stock. And he didn't want to do it, but they kind of outmaneuvered him. So he said, all right. So they created the Class B shares, which initially sold for $1,160 each. See, they wanted something around $100 or something like that. But he said, all right, I'll give you your Class B shares. And in the prospectus, which you're supposed to give to all the would-be potential investors, he said, I wouldn't buy them. Yeah, don't buy them. Buy the A shares. If you want to invest in me, buy the A shares. But hey, the B shares did okay. And what happened was later on, it turned out that the B shares became a source of capital, a way for Berkshire Hathaway, a way for Warren Buffett to use the B shares like cash to buy other companies. And so he said, this has worked out okay for me. And they split the B shares 50 for 1. Whoa, you had 1 share or 10 shares, you now had 50 times more, but the price, of course, went way down. And it was easier to use them as like dollars, like cash. They now sell for around $362. So obviously, $550,000 for 1 share of the A shares and $362 for 1 share of the B shares. But now, many brokerage firms allow you to buy fractional shares. So say you have $2,000 or $1,000 or even $500 to invest in Berkshire Hathaway. You can buy the A shares and you'll get 0.0011 whatever, just a tiny little piece of the shares, but the brokerage firms will take care of it. They'll buy several shares of the A shares, and then they'll do all the accounting work. Now, my question, and I've asked this of Schwab and they never got back to me, I got to ask him again. How much are you charging for this service? Because obviously, it's going to cost them money to do this, the brokerage firm. And so how much are they charging? In other words, what kind of bid and ask prices are you getting? Because again, they'll say, well, we don't charge any commission. Yes, you do. It's just hidden. So I got to find that out. I have to do that. I called, and it took me a while to actually talk to somebody who knew what I was talking about. And then he said, I'll get back to you on that. And then he never did. And I have to follow up. So that's the share classes. Slide. Come on. Let's go to the next slide, please. Slide 64. Common stock values. Now, here's where we start to take a look at some of the numeric measures that we use when we look at stocks. Every stock has a par value, which is, I'm not exactly sure why they do it, but it's fairly meaningless. It'll be set 1 penny or 0.01 penny or something like that. It doesn't mean anything. But the book value does. This is the amount of shareholders' equity in a firm minus, all the assets of the firm minus the liabilities and any preferred stock, which we'll talk about later on. So in other words, this is the equity. This is the net worth. If you remember, if you took Business 121, Principles of Money Management, or you took accounting, you'll know that equity equals the assets minus the liabilities. They go by various names. Assets minus liabilities equals equity. Assets equals liabilities plus equity. In other words, if you pay off all the debts, what's left over? But that number is something that we want to look at, but it's not very important, especially if the company is doing well, because it's not going to be anywhere near the market value, the price of this one share of stock. Typically, the market value is going to be 3 or 4 or 6 or more times more than the book value. And look it up when you're doing your research on companies in Chapter 3. Look at the key statistics or the statistics, and the price is prominently displayed, but the book value, most people are not interested in it, so they stick it on that statistics page. And you'll see that typically it is much less. In fact, you'll see some companies that have negative book value. They have more debts than they have assets. I know. Yeah, can it sound familiar for some of you? So check that out. Check that out. But more important is the market value, the price of the stock. Slide number 65. Now we get into dividends. One of my favorite things to talk about when we talk about stocks. Dividends are distributions of earnings given to the shareholders. In the United States and all countries that had something to do with the United Kingdom at one time or another, like Canada, Australia, Hong Kong, who else? South Africa. These countries typically pay quarterly. Other countries will pay every 6 months or maybe just once a year. The board of directors decides how much, if any, dividends should be paid and when to pay them. Dividends are usually a percentage of the earnings per share. So in accounting, you learn how to calculate the earnings per share of every company. It's not really hard. You take the net income and divide it by the number of shares outstanding. And from that, the board of directors will decide how much, if any, dividends are paid. Remember, dividends are optional distributions of earnings. Unlike interest payments from a savings account or from a bond, interest payments from a bond, which are mandatory, the company doesn't have to pay dividends. But some companies have been paying dividends for decades or over 100 years. So that's a pretty good track record. Earnings per share example on slide 66. Let's say a company reports net profit of $1 million. That's a lot of money to you and me, but to a company that might be very small. We don't know how many shares are outstanding. So let's say this company has 500,000 shares outstanding. We take the $1 million of earnings and divide it by the $500,000 shares, and we get $2 of earnings per share. And again, don't worry about it. It's done for you. All you got to do is look it up. So you could think of your little one share of stock as a business that's earning $2. And the board of directors might decide to pay out 50% of the earnings per share in the form of dividends. So they'll say, okay, we're going to pay 50% of the earnings that we made. So therefore, every shareholder would receive $1 dividend for each share they owned. And this is called the dividend payout ratio. You take the dividends divided by the earnings per share, and you get a dividend payout ratio, in this case, of 50%. Now, companies that are growing, newer companies, are they going to be paying dividends? Maybe a little bit. If they do, they're going to be paying a very small dividend payout ratio. Why? They need the money. They need the money to reinvest in the company. Companies that are large and have been around for decades, like banks and utilities and railroads, and well, railroads haven't. They're a very capital intensive, fancy way of saying they need a lot of money to keep the darn railroads going. They're going to be paying out higher percentages. They're going to have higher dividend payout ratios. So let's take a look now at slide 67 and look at the dividend yield. This very important statistic is a measure that relates the dividends to the share price and puts stock dividends on a relative percentage basis rather than an absolute dollar basis. So, for example, in the stock in the previous slide was paying $1 dividend. Well, what was its price? Well, if the price were $20, the dividend yield would be 5%. That's a very simple calculation. And again, it's going to be, all you got to do is look it up. But we'll ask you to do a couple of these calculations on worksheet number 2, I think it is. Not very hard, folks. Take a dollar dividend divided by $20 price, and you get 5%, 0.05, which is 5%. And if you have trouble with that, contact me or contact the folks at the Math Tutoring Center. This makes it easier to compare stocks with other income-oriented vehicles such as bonds or savings accounts. As we said, traditionally 3, 4, 5, 6 was considered normal. In the 1990s, dividends went down to 2%, and then finally, in March of 2000, they hit 1%. Dividends went above 3% in 2008 and 9, but now they are back down to below 2%. So some people say, yeah, stocks are still really expensive on a long-term basis. And, they might be right. But a lot of it depends on investors' expectations. If they're not that interested in dividends, what do they care? Well, I'm interested in dividends. And, 2-3% dividends, it's not bad. Could be better. Some are paying better. But 0%, oh well, that means the stock better be a good growth prospect because they're not paying you anything in the form of dividends. Or maybe you think that eventually they're going to start paying dividends. Yeah, like some of the tech companies, which are now pretty good dividend payers. Slide 68. Now this one's a little tricky, so get your little notepad out, make some notes, and maybe make some flashcards or whatever. The declaration date is the day that the board of directors declares the dividend. They say, okay, today we declare a dividend. And they say which day in the future, you typically, several weeks, you need to be a recorded investor. You need to be an official investor in our shares to get the dividend. So they give you several weeks to decide whether you want to buy the shares. That's the date of record. That's the date on which the investor must be registered shareholder of a firm to be entitled to receive the dividend. It's not that easy. You really need to buy the shares at least 2 days before the date of record. That's called the ExDividend Date. Why? 2 business days before the date of record is the ExDividend Date. This is the real date that determines whether one is an official shareholder of a firm and thus eligible to receive a declared dividend. Next slide. And then the payment date is actually also called the distribution date. That happens a few weeks after the date of record. They got to get they don't send checks anymore. It's all electronic. But some people still, have their shares in what's called certificate form, and so they might get a check in the mail. But it's all electronic now. So now, wait a minute, slide 69. Why is the ex-dividend date 2 days before the date of record? Well, it's because of how stock transactions occur. Stock transactions close in 2 days. So if you purchase the stock on June 15th, in this case, you don't get it until June 17th, assuming it was a Monday, Wednesday, or Monday, Tuesday, Wednesday. Because of course, if there's a weekend in between or a holiday or whatever, that pushes it back. So let's say that it's the Monday, Tuesday, or Wednesday. You buy it the 15th, you don't actually get the stock until the 17th. And the same thing is true when you sell a stock. If you sold it on the 15th, you don't get the cash for 2 days. Theoretically, the opening share price on the ex-dividend date should reflect a drop in price commensurate, you like that word? Means along with, the amount of the dividend. So, for example, if there's a $1 per share dividend, the opening stock price should be reduced by $1. Well, it doesn't really work that way in the real world because prices are changing all the time. But so understand that you need to buy the shares before the ex-dividend date so that you actually are a owner of record to receive the dividend. Slide 70, you will see a phrase that you'll hear in the industry. Don't buy the dividend. It's a common saying in the industry. Here's the translation. Look, you're better off waiting until the ex-dividend date before buying a stock. And here's the logic. Although I'm not a big fan of this, especially with us smaller retail investors, because the amounts are not that big a deal. The logic follows thusly. Dividends are taxable transactions. So if you buy the dividend, if you buy the stock just before the ex-dividend date, you're going to be responsible for paying the taxes. And presumably the stock price will fall commensurate with the amount of the dividend. So you're better off waiting until after the ex-dividend date so that you will get the stock at a better price and not generate a taxable transaction. I don't think this is important for, unless you're talking about vast sums of money. Yeah, sure. If you're going to buy hundreds of thousands of dollars of a stock and they're going to pay very rich dividends, yeah, wait until after the ex-dividend date, or wait until the ex-dividend date, and then you don't get hit with the tax bill. But it's not something that we little people have to usually worry about. You want to buy the stock, buy it. You want to sell the stock, sell it. Yeah. This is something, though, you should think about if you have a large amount to invest in mutual funds near the end of the year, because that's when they typically do their capital gains distributions. And you buy, say, in December 1st or whatever, December 3rd, 2nd or 3rd, you put in $100,000 or whatever. You might be hit with a 5%, 5,000 or so capital gains distribution. And then you're going to get a 1099 and have to pay taxes on it. Well, you're going to have to pay taxes on it anyway, eventually, but sure, wait until after the capital gains distribution. Again, if you're putting $500 in, it's $5. What's the difference? Slide 71. There are two types of dividends. Now, if you don't quite get this distinction, don't worry. Just know that you want cash dividends, okay? Because cash dividends are real payments. They are payments of the dividend in the form of cash. And that's what you want. You want them to pay you. Stock dividends are payments in the dividend of a dividend in the form of additional shares of stock. Huh? Well, this is kind of like a stock split. All other things being equal, and of course they never are, stock dividends have no value because they constitute a dilution of ownership. They've issued more stock. Right. So example, the board of directors declares a 10% stock dividend. So for every 10 shares, you're going to get an extra share. Whoopee! You had 10 shares, now you have 11 shares? Oops. Correspondingly, the price of the shares dropped 10%. So there's no change in value. It's an accounting maneuver again. But unlike a cash dividend, a stock dividend is not taxed. Well, thank you very much, IRS, for not taxing me on something that's not worth anything. Isn't that nice? They're not giving us anything, so why should we be taxed on it? But it might make us feel good that we have more shares. Look, if you're with a company that's paying you in stock dividends, maybe you ought to reevaluate whether or not you want to be with this company as a partner, as an investor. Here's where it gets a little trickier on slide 72. There are dividend reinvestment plans, DRIPs. I love the name DRIP. You want a DRIP? Yeah, you do. As a matter of fact, I'm a big fan of DRIPs. These are plans in which shareholders have cash dividends automatically reinvested into additional shares of the firm's common stock. So you see, they're paying you cash, and it is a taxable transaction, but there's no additional shares that were issued. What happened is they went out into the marketplace, bought some shares, and gave them to you. Now, the company doesn't usually do this. Somebody does it on their behalf. There's an example on the web page and in Canvas of SDG&E, Sempra Energy, where CompuServe, I forget the name of the company, but they were the ones handling the dividend reinvestment plan on behalf of Sempra. So Sempra would pay us a dividend, and then this company would go out there and give us fractional shares. And this way, it's kind of like a mutual fund in that you don't have to worry about reinvesting the dividends on your own. It happens automatically. So dividend reinvestment plans are not stock dividends. They are cash dividends, but they automatically turn that cash into additional shares. So definitely check out the example on the web page of Sempra Energy DRIP. Let's read together. DRIPs are an excellent way to own stock for those interested in long-term growth and are not interested in the current income. It allows the investor to take advantage of compounding automatically with normally no or very small transaction costs. On the example, it doesn't show any transaction costs, but every once in a while, under fees, they would charge us 6 cents. Literally, 3 or 9, 6 or cents, 6 cents or so. So that's how much it was costing them to run the program. So it's a very, very cost-effective way. Now, most brokerage firms will allow you to do dividend reinvestment plans, automatically reinvest your dividends for you. So very cool. Remember, DRIPs, dividend reinvestment plans. And finally, in this presentation, let's take a look at the most important and most widely watched common stock valuation measurement, and that is price to earnings ratio, PE. So you'll see it written as P/E. Sometimes you'll see it PE as in physical education, but no, PE. This is a very simple calculation. It's the price of the stock divided by the earnings per share. So we had a $20 price in the previous example, the $20 stock, and $2 of earnings per share. So you take $20 divided by $2 and you get 10. The dollars cancel. I don't like that word, but that's the word we use in math. The dollars disappear and we're left with 10. Now, if you put a dollar sign or a percent sign, I'm not going to mark you off or anything like that, but PE is unitless. So $20 divided by $20 stock price divided by $2 of earnings per share gives us a 10 price to earnings ratio. Now, what is that high? Is that low? Well, it depends on who you talk to. Most of the time through history of the stock market, the PE ratios between 5 and 15 were considered normal. Anything 20 or above was only reserved for the fastest growing stocks. But during manias in the late 1920s and then the 1960s and early 70s and then in the 1990s and then recently, PEs of 30, 40, 50, 100 were not unusual. And during the downturns, right, the parachutes better be very large because when the prices start falling, the PE ratios come down greatly. We're going to spend a great deal of time learning about PE and other valuation techniques in the next 2 chapters. So just whatever's on worksheet number 2, just you go ahead and play with and realize that these are very simple calculations. And the reality is you don't have to do them, you just look them up. But we want you to understand these very simple calculations. So now in the face-to-face class, we would go through worksheet number 2. There's an answer key, commentary, so you can do it. And of course, if you have any questions, you contact me. Is it starting to gel, folks? Go back over these, listen to them again. I like repetition because in our next presentation, we're going to take a look at common stock types, different types of companies. And we find that not all companies are the same, but there are certain categories that some companies fit in. Some fit in more than one, some don't fit in any. And we're just going to scratch the surface and take a look at some major types. And I'm going to reiterate, we want you to memorize these. And then you're going to use those types in the first assignment in chapter 3 when you go through and investigate the companies we ask you to investigate. Cool? Thank you again, over and over again. We thank you. We're so proud of you. We're so happy and honored and privileged and grateful that you're with us. Be awesome, dear students. Be fabulous and fantastic, dear rising investment gurus.